Many months ago, I was pleased to be joined by a colleague in Italy who lectures on options and using probabilities. And we're going to have him back on OpenMike today. And we're going to talk about those things. Hello, everybody, and welcome. I'm Mike Coe. Welcome to OpenMike. As I just mentioned, several months ago, I was very pleased to be joined by my colleague, Dom Dall'Olio, who teaches options theory, and he teaches about probability and statistics for investing and trading at two universities in Italy. Dom, welcome back.
Hi, Mike. It's good to be back.
What hour is it there? Because I'm in California, but it's got to be getting pretty late at night.
Yeah, it's 10:15 p.m.
Okay. Well, thanks for staying awake to talk to us. So, the last time you were on, we touched briefly on the system that you employ for identifying trades, combining that with some fundamental analysis. And I thought now would be a really good time to bring you back for two reasons. One, as I understand it, you have released this product in beta to some select clients of yours in Italy. And although I don't think we put it in the description, for those who are interested, who are watching this now, we will be offering a limited number of beta licenses to people here also, if they might be interested in doing it. So having said that, could you just sort of frame this up for us a little bit? Just talk a little bit about what the platform is and how it works.
Yeah, sure. The platform TradeAI is a platform created by Vladimir Furman, and it's all based on probabilistic proprietary models, which basically try and describe the typical behavior of the underlying over some number of previous years. So to try and give you a multi-angle view of the same phenomenon when you have to try and decide which trades to take. And basically it looks back to the recent history of the underlying up to 5 years. Some models also look back up to 6.5 years. And they, as I said, they try to let you understand what is the typical behavior of the underlying so that you can form an expectation about what might happen in the near future. And you could use it both for selecting the best trades, the trades that have the best risk-reward profile when the underlying companies are about to release earnings. But you could also use it in order to try and spot the good trading opportunities on stocks that already announced earnings or that are about to release earnings in a month or even more, so that the volatility is growing, but there's not yet the event coming, and maybe you can find good opportunities for the short term. And the probabilistic models can be described in very simple words, basically, because there's nothing too complicated. Of course, the platform is quite sophisticated. The models try and describe, the typical behavior in ways that you don't find anywhere else. But in the end, it all comes to, the description of, again, what you might expect from the underlying according to what it's been doing typically in its recent history.
So you mentioned earnings. So I assume then that the models are, of course, then taking the current context into view. That is to say that the system is aware effectively of whether you have earnings upcoming, and so it's evaluating, creating essentially a histogram or an anticipated return distribution for the underlying equity, comparing that to the prevailing options prices, understanding where it is in time. In other words, did earnings just happen? Is it about to happen? Is it not due to happen for some period of time, call it 30, 60, 70 days or something like that. Is that a fair way to characterize it?
Yeah, there's a couple functions that you can find with regard to earnings. One is the so-called earning probability, which is basically, it's a distribution of returns, conditional, because it's related only to the periods in which earnings are released. So it's a conditional distribution of past returns. And you also have so-called statistical path. It's a trajectory cone of the price, which takes into account both what usually happens on the stock in some period of time and what happens only in the specific moments where earnings are coming, which usually makes the cone being, more
A little bit wider.
yeah, even more erratic. It's
Mm-hmm.
not the shape of the cone is just not a parabolic curve. It's always something going like this because earnings makes more volatility come into play.
So the way the beta version of the application is working, essentially those users will just receive a daily email, right? In that email, you get at a high level just the trade idea, but it has dynamic links within it so that you can delve into the system a little bit more deeply. Is that right?
Yeah, because as we can say, I believe what I'm seeing on my screen is the email. Can we share it, Mike?
Yeah. Actually, I get the email, and actually, yeah, we can show it on my screen. We can show it on my screen, I think. So I'm getting these emails, and because I happen to have written about one of these stocks a couple of times, so I wrote about it on CNBC. I'm quite sure I did at least 2 videos about it on this channel, and I happened to see that it came up, and that's BJ's Wholesale. So for those that don't know, BJ's Wholesale, chances are if you live on the East Coast, you know what BJ's Wholesale is. If you don't live on the East Coast, maybe you don't. BJ's is like a smaller version of Costco, subscription-based grocer, some general merchandise. And I have periodically liked this one on the long side or liked this one on the long side as part of a pairs trade against Costco when the valuation spread widened. Let's start with this and just simply say that Costco is the best of breed. This doesn't take anything away from that. Costco is a bigger company. They dominate this market space, and they are growing more quickly. That's not to say, though, that BJ's isn't in number one as a grocer in a relatively stable business, in a business that can presumably benefit in the event that you have consumers who are a little bit cash strapped. But let's take a look, because one of the trade ideas that came up here, and actually I'm wondering, does this expand that? Oh yeah, look at that. Okay, that's handy. So high level, the trade idea is sell the May 1585 puts, which is a pretty substantial discount to the current stock price, which is close to 100. And if I click on the AI report, that's how I delve into a little bit more information. It'll pop up on another screen, which will hopefully come up over here if I don't have too many of my firewalls on. And you get this report. Are you able to see what's on my screen right now, Dom?
Yeah.
Okay. So maybe you can just lead the viewers right now. I'm going to blow this up a little bit more through what we're looking at. Some of this is pretty straightforward. So you get an outline of what the business is. You can see what the 52-week price range is. You can see what their sector is, when the earnings are, and that's actually coming up in 1, 2, 3 weeks, I guess, and what the consensus estimates are. But what are the other things that you like to look at when you look at these reports if you're looking at a name like this? And is BJ's a name that you have also evaluated from a fundamental perspective?
Yeah, I have, because I was checking this late afternoon for trades I might be willing to take, and I was focusing on BJ's because I have my own platform for the evaluation of fundamental parameters, and I have some personal ratings of the the goodness of the company, and I have my I have my rating for the earnings, my rating for the debt, my rating for the ROE. Sorry, I'm used to say ROI,
Mm-hmm.
and other parameters that I look in order to try and decide whether to take the trade or not. Because basically, my trading style is 99% naked puts. So every time I go through all my selection process, I basically try and find stocks that I am not afraid of being assigned if things go the wrong way, just so to speak. And
Mm-hmm.
I usually look for trading ideas having at least a 70% probability in favor on among all the models available in the platform TradeAI, and with
This
all.
one has a 91. Is that the way I should read that? It says a 91% win rate. Yeah.
Yeah, that's a weighted average of all the models. But if you scroll down in the AI report, down to the last table, you will find a list of alternative trading ideas.
Mm-hmm.
No, just a little bit more. Yeah, there we are. And
Mm-hmm.
if you look again to the May 85 put and you hover the cursor over the probability of profit, the column,
Mm-hmm.
yeah, you will see all the details of the 10 probabilistic models included in the TradeAI platform. And as you can see, the long stress test probability is the lowest value, which is a 77%, which is fine for me because 70% is my minimum threshold. And even if you scroll to the profit and loss column on that 71 value, you see that the expectation of profit according to the normal distribution and the long stress test is negative, which
Mm-hmm.
usually means you shouldn't pick the trade. But if
Mm-hmm.
you're not afraid, again, of being assigned the stock because you believe the stock has a good fundamental profile, then you might overpass these negative values and take into consideration the fact that uh, on average the expectation of profit is 91%. So with an
So
ROI,
in a
yeah,
in effect, then you're basically the system is in this way showing what the expected profit or loss of the option is. So this is how much you expect to make or lose, not the price of the option, but how much you expect to make or
exactly.
lose based on all of these different models. So in effect, if in this case you've got 10 models, right? Is that right?
Yeah,
10 models, it looks like. And 8 of them are positive. The 2 that are negative are only by relatively small amounts. I mean, one could say that the short historical is that's not a huge profit. Oops, I should have left that up there. But when you blend all of these things together, is that what this $71 is? That's basically the average of all of those statistical models.
yeah, it's the weighted average of the expected profit weighted by the probability to achieve it minus the potential loss weighted on the probability to suffer it.
Mm-hmm. And this gives us an annualized return on investment of about
Exactly.
27% then.
Exactly.
Mm-hmm.
Yeah.
Now, one of the other things that I'm noticing here is that let's see where so I saw RSI here. So this is also taking into account technical factors like the relative strength. What is it relative to the broad market, to the sector, the industry, all of these?
Well, the RSI is the typical indicator you find in any trading platforms. And I don't know exactly the specifics of the algorithm because, it's a industrial secret of Vladimir Furman. Anyway,
Mm-hmm.
I believe that the RSI as the stochastic and the PPO are set using the same parameters, no matter the underlying. And here the platform looks back about 6.5 years, seeking for market conditions similar to the ones we're having today, and for a trade with similar characteristics to the one we are considering today. So basically, more or less the same days to expiration and the same distance of the strike price in respect to the current price of the underlying. And then it checks if every time in the past you could have taken a trade similar to the one you're considering today, how it would have ended. And basically, in the end, it calculates the classic definition of probability, number of favorable events divided by the total number of all the events. And so it's converting a typical strength indicator you find in any charts into a probability measure.
Mm-hmm. And let me just go back to this really quickly, because one of the things I was curious about here. So that's $85. So you would be net long the stock at $85, less the premium collected, which I don't know when it actually took its snapshot, but that's going to be probably, we're going to call it, we'll say that that's 75, so 37.5. We'll call it, in fairness, we'll say $1.65. So 85 less $1.65. So you're going to be getting long at $83 and change, which is a pretty good discount to the current stock price. We'll call it 83.35 versus, we'll say 9 to keep it easy. We'll call it, so that's about a 16% discount to the current stock price. So while we're doing that, since I happen to have it up, I know you have a system all your own, which you're welcome to share on your screen if you wish, with respect to the fundamentals and things like that. But since we happen to have my screen showing at the moment already, I might as well just bring up on the Bloomberg what we're looking at here. So just a quick reminder, when people are looking at these financial statements or estimates, just keep your eye up here. Because most of the time when we're looking at these columns, the header is going to say the last day of December of the respective year. And the reason I point this out is because their fiscal year ends in January. So it's really, when we think about the forward numbers, we're in February of 2026. So everything from here back, all of that, even though this is still white, this is simply white because they haven't announced their earnings. We know they're going to be announcing their earnings on March 5th. So really the numbers that we're interested in are the ones upcoming, and what we're looking at is $4.66 a share estimated, so 99. That's 21.2 times forward earnings is where it's currently trading, but relative to where you would actually own the stock if it was put to you, which we just previously figured out is 83.35. That means that if you do own the stock, you're actually going to own it at 18.7 times forward earnings. So after that, we can then say, okay, well, what has been the historical range for this thing to see whether that's a relatively attractive level to get long the stock. What we can see here is that, well, that's actually very attractive, isn't it? Because that it's already trading at the low end of its historical range. So let me just expand this to 5 years. Let's see if it's when's the last time it traded as cheap as that? It must have at some point in the last 5 years. So on a price to forward earnings basis, that would be, what did I figure out? 16% discount. So effectively, another way to think about this is that if you put the stock at that multiple, the worst it has ever traded relative to forward earnings in the last 5 years at any point, which would include things like the post-Liberation Day low when there was a big stock swoon and a couple other material setbacks. That's going to include the near bear market. We actually achieved an intraday bear market in 2022 when we went through all those rate increases. But effectively, one way I would think about this is that if I own the stock at 83.35, the lowest valuation it had ever traded at in the last 5 years relative to forward would be maybe down another 18 to 20% from that depressed level. So if you're looking at this distribution, that's going to be right over here. So think about it this way. This is the historical range relative to forward earnings. that the company has traded at over the last 5 years. If you are put the stock at the strike less the premium, you're going to be buying it in this area right here. So not bad. I like that idea. Good. Okay, we'll put that one in the books. You got anything else for us?
Yeah, I believe it could be interesting also to give a look to the put vertical spread suggested on Cameco by
Okay.
the newsletter.
All right. Well, let's
Because
take a peek.
it helps us pointing out one very important thing which is that all the suggested trades you find here are high probability trades generated by very sophisticated platform with very sophisticated algorithms. But you always have to remind that the final decision is up to you. So you have to, to put together not only the probabilistic view of the platform trade AI, but also with your personal views and your personal inclination to risk, your personal inclination to some specific type of trades and the like. With regard to myself, just to say, I must confess, I don't like vertical spreads, okay? Because with the vertical spread, when things go bad, it's very easy to be completely overpassed by the price movement, and there's nothing you can do about it. You just suffer the loss, and that's it. So whenever I inspect the markets looking for the best opportunities, I always look for stocks that I am not afraid of being assigned if things go bad, and always look for naked put sellings. So in the case of Cameco, can you go back to the
sure.
email? There's a vertical spread suggested, as you can see, short 100 put and buy and long 95 put, with a very good winning rate, 89%, and an expected credit of 69, which actually is quite pessimistic, because if you looked at the market conditions close to the closing of tonight, the net credit would have been way better than that. Anyway, my point is that instead of taking a vertical spread distance $5 in order to try and get a profit of 70, 75, even 80 cents, what if you go naked on a lower strike price put, just to say, for instance, the 95 put? The 95 put provides a gain way above the credit put spread one, and being another $5 lower with the short selling, you are in a safer position. Okay, so once again, if all the lights are green in respect with the fundamental view, and all the lights are green in respect to the probabilistic models, because the philosophy of the TradeAI platform is that no model is better than the others, because each model by definition is just a model. It tries to depict the reality, but sometimes even the best models can be wrong. So in the end, you are not seeking for the best model, you are seeking for the same readings among all the available models. But I can tell you in my experience that the stress test probability is not to be fought. When stress test probability says no, it's no. Okay, it's better not to take the trade. So my general rule is that when a stock is good, I mean on the fundamental point of view, and I'm not afraid of being assigned, even if it's $95, which means $9,500 in a single position on a single stock. So of course, it all depends on the capitalization you have on the account. But my general rule is that the minimum probability has to be at least 70%. When all the probabilistic ratings are at least 70% and the fundamentals of the stock are good, I go naked puts all the time. Okay, and if I get a sign, I can manage it. I can do covered calls and the like.
Well, I guess that would have to be the approach, wouldn't it? Because it seems, as I scroll through this, like there are, this is just from today, and there are a lot of trade ideas in here and a lot of different stocks. And if I look at these reports, what I'm seeing is that at the bottom, there's a table that's provided, and in that table, it shows more than one trade idea. So presumably, Dollar General, this is another name I've talked about. I'm not super crazy about the space because of, so there's actually 4 trade ideas here that have positive expected P&Ls.
Yeah.
So the way to think about it, I guess, then, is that this is another tool. Fairly, I would actually say it's actually, a composite of several investment tools that should be combined with your pre-existing investment process. That's a fair way to say it.
Yeah.
Okay. By the way, I don't know whether it's a follower of yours. If you happen to mention, or if somebody else in Italy is also up at a late hour, but someone says "Ciao, Domenico." So I don't know if you see that. I'm assuming that it might be somebody that you know, or maybe one of your students.
Maybe.
Who knows?
Let me stop sharing my screen.
You can.
Oh, no,
you
I'm
can
not
then
sharing
maybe
my
see.
screen. Okay.
Yeah, if you're looking at the return, Gianluca Dati.
Ah,
I
yeah.
think.
Okay, I know him.
Ben trovato, he says. No, I don't speak Italian, but that looks like how one might pronounce it. I don't know if that's right or not.
Yeah, it means good to see you.
Yeah. So looking at Cameco then, so this is kind of an interesting one for those that don't know, and actually if you had the system. So again, we're not going to do this because in a beta test environment can only have a limited number of users, but for those who are watching this, if you are interested, what's going to be a good approach? Number one, not in the chat, but instead, if you're interested in getting access to this on a beta basis, what you would do, by the way, is you would get access to it. You'll get the email. You can use it. The only thing that Vlad, Furman, and us and everybody else are going to be looking for is just give some feedback on the use of the application so that it can be essentially enhanced till it gets to a comfortable production variation. So this is a way that you're going to get access to something that would normally probably cost a decent bit of money for free. You just have to lend your thoughts and opinions to what you're getting. So yeah, so let's see here. Let me just double check. I'm gonna see what happens. Bills at. I'm gonna try to send something to. I'm just gonna see if this bounces back. But I got the email from sales at OptionsTradeAI.com.
Mm-hmm.
So I'll tell you what. Put a comment into the chat if you're interested, or you can. We will put in the description to this video. For the next 24 hours, we will put the contact information within the next 24 hours. So there'll be a link to an email address that you can use. And you can put your contact information in, and you'll start receiving this. These emails come out every day. I've been getting them. So, looking at Cameco, again, for those that don't know, uranium play. If you had this, you can see that very quickly. Obviously, a very hot trade. I'm going to scroll down the way you had me do it before to the bottom, or is there something else you want me to look at before we get there?
No, it's okay. You can scroll down.
Okay. So this was the put credit spread that the system identified. Your choice, though, because you prefer to sell naked puts or cash secured puts sometimes if people are what we call fully funded, is actually to sell the put that it's buying simply based on your assessment of and actually I'm going to bring up the same. Oh, look at this. Okay, so once again, it has, so the short stress test here, you had mentioned before that you like to see everything above 70. This one's 64, the short stress test model.
Yeah.
But you're okay with that, I take it?
No, I would discard this trade. Just not just because of the short stress, but also because it's a vertical spread, which I don't like.
Now the probability that it gets to the lower strike that you had indicated you might be interested in selling, though, is lower than this probability, because this 64% probability, is that based on the break even, or is that based on testing the strike?
It's based on the break even.
Okay, so 64%. So that's a 64%. If you choose the 10 models, the model that assigns the greatest risk to this trade. So that's essentially what you're doing. Is you're saying I've got 10 different models. They all have different risk assessments of the trade I'm looking at, and you always just look to the absolute worst. You just say, okay, I really am looking to make sure that I have a very low probability of assignment, and I'll similarly I'm willing to be put the stock in the event that I am assigned, but you're looking for very low assignment risks. So in this case, this number is saying there's a 64% chance that the stock violates the 100 strike short put in this case by, in this case, whatever the market price is. So that's going to be that 64% chance, by coincidence, that Cameco gets down to 99.36, right?
Yeah, actually, there's a 64% probability that it will stay above 99.36.
Oh yeah, excuse me. Yeah, that's right.
Yeah.
Okay.
And
okay. And this is where you can sort of see that the expected profit loss on this one. But again, this is just a way that people can kind of use this in conjunction with their own analysis.
exactly.
I see. Okay. And actually, do we have a mechanism by which we can? I don't know. We might even be able to take people's questions and look at stuff this way. But I'm going to start looking at the chat here. And so, yeah. So Matt McDonald, how do we get beta? We're going to put it into the description for this video. If you put your information, though, an email address, into the comments, again, not the chat, but if you put it into the comments inside of the next 24 hours, we'll look at this. Okay, actually, the producers told me that's not the best approach, but so I apologize for that. But what we are going to do is we're going to have a description. You'll send you will reach out to us at the email address that we provide, which I believe is going to be sales@OptionsTradeAI, but I will confirm that with Vlad, and we'll do some tests on
Yeah,
that.
I'm not 100%
yes.
sure it can receive emails that address, so
Yeah.
we have to check.
Yeah, we will double check that.
Yeah.
But okay. All right. So here's a question. I made some money on MDT covered calls since December, but decided to dump my shares today because there was just no premium available. What
It
gives?
happens.
The stock seems to move quite a bit to me. So yeah, to your point, Dom. Yeah, why don't you sort of give your general opinion, and while I pull up MDT more specifically, and we'll see what's happening.
Yeah, generally speaking, one risk of my way of trading, meaning naked puts, cash secured, and managing the positions in case of assignment, is that after the earnings, if it's the case, of course, the volatility drops so much that it is sometimes it can be very hard to short sell calls against the position in the stock. Sometimes it happens, and sometimes it takes patience to wait for a new spike in the volatility so that you can sell a call, or maybe the stock bounces back up and you can close the position right away. And so sometimes it happens that you need to be patient. And but in my experience, most of the times, my first and most important requisite in stock picking is the effectiveness of the option chains. And I mean with this that when you say efficient options, 99% of the people think of the bid-ask spread, but bid-ask spread is not a problem, because if you know how to decide the price to try and send your orders to start from, the bid-ask spread is not a problem. I've been dealing with options quoting I don't know, 0.50, 4.80. Okay, and I was able to get a fair price for my selling of the options. So
So a $4.30 wide option.
yeah, exactly. It's a
Yeah.
1,000% spread sometimes,
Mm-hmm.
but that is not a problem. That is not a problem. You just know, you just need to know a couple of rules in order to try and find a good price to start from, which doesn't mean you're going to be executed, because even if the price is right, it doesn't mean you're going to be filled.
Get a fill.
Yeah,
Mm-hmm.
so sometimes you just have to start from there and move a little bit every 5 minutes until you get the fulfillment of the order. And what I mean with the efficiency of the options is the distance between the strikes of the options listed. Because if I have a stock quoting $50 and the strikes are distance $5 each other, it's impossible to manage any assignment. But if the strikes are every dollar, or even better, every half dollar, then you can manage the positions all the time, which means that sometimes you have to take the risk. I don't know, you sell a put for $30, you get a sign, the stock drops to 20. And of course, you cannot sell the call 30 because it's worthless. And you have to decide whether not to do anything or to pick a lower strike. And here, another tool of the TradeAI platform comes in, which you don't find in the Trading Ideas newsletter, but you find only in the platform, which is the call probability matrix that helps you deciding which strikes to sell against your stock positions in order to maximize the expected return, minimizing the risk of being taken. Okay. Anyway,
Mm-hmm. Well, so it's interesting. In the meantime, what I did was I pulled up the implied and realized volatility for Medtronic over the course of the last 5 years. You're right. Medtronic options are not particularly expensive. Implied vol going out 1 month is just 20. That is below the mean. So the mean over the last 5 years is actually closer to 22. That's up here. And if we look at the price of options on a percentile basis, the implied volatility going out 1 month in Medtronic right now is 36th, almost the 37th percentile, but it's not even at the mean. So if you were selling options here, not only are you not getting a lot of premium, so you're not being handsomely rewarded for selling options, but you're also selling options at a price that is, below the average level for options on this stock. And you can see it's actually, it behaves with some regularity. You get exactly as Dom was just talking about. You get these events, you get these catalysts, and then vol drops off. Now, this green chart that I'm showing here, this is the difference between how much the stock is moving and how much you are being paid for an option. So if putting it to you this way, if you sold an option and the number was very high, that's good, because that means that the difference between the implied volatility in the option and the realized volatility of the stock is wide. When the number is low, that's not so good, because that suggests you basically ended up selling an option that, if you were a volatility trader, proved to be more valuable than that. Right now, it's actually just under zero. So your intuition is treating you well. And I think that's actually an important point to make in general, that sometimes you can look at a situation, kind of as Dom was just alluding, you need to put a lot of things together as you are deciding what trades you will do and how you're going to do them. Your intuition that this thing is not paying you a lot for the risk you're taking relative to how much it actually moves is spot on. Right now, the options are not priced commensurate with how the stock's been behaving recently. So, all right. So, dividend degenerates. Hi, Mike. Good to see winter trading again. Yeah. One of our funds, Dom, you wouldn't know about this, but we have a number of options-based ETFs.
yeah.
And 61 of them, globally. And, there's over 50 in the United States. One of them was halted today. I didn't know why. I guess there was some kind of a mismatch with fund admin or something like that. But basically, sometimes securities get halted when there is information that needs to be released or disseminated to the public, and they want to make sure that everybody gets a chance to digest it. So they'll halt the stock, or they'll halt the fund, or whatever. that happened today. People were asking me about that. Number one, I can't disseminate anything if I knew anything in that case, because everybody has to find out at the same time. But actually, I didn't know anything. I didn't know why it had been halted. So, yeah, there was that. Oh yeah, FinWest. So FinWest is a frequent viewer, and FinWest remembered when you were on the last time. So he's glad to see you back here. Next one, Mike. I picked up some PANW, Palo Alto Networks, July 170 calls before earnings. Can you talk about how you handle positions that aren't working with time left? Always too tempted to be optimistic. So I think what you mean is that you are in a trade that's not working out and you're hoping it gets better. So first of all, Dom, I'm going to look up the Palo Alto July 170 calls, but do you have any thoughts, just sort of trading ideas or education for the trader who buys options, presumably going into a catalyst? I don't know, because you didn't mention when you bought them, and the trade doesn't work. What is your sort of rule, Dom, for how you manage trades that are not working?
That's a very tough question, because I only buy options, generally calls, when I spot suspect movements in terms of opening interests. And, all the other times, in any other situation, I'm an option seller. I was speaking of Palo Alto Networks a couple of days ago because it was going to release earnings, and I made a video for my my subscribers of my personal site, and I suggested not to go on naked puts on Palo Alto, because it was trading about at the minimum of the past year, and I believe that usually there's a reason for that. And I think the risk of facing a dramatic drop is higher than the opportunity that you can get if you're just selling a put, which means you're collecting a limited premium. So I suggested not to take any naked puts on Palo Alto over the last few days, and it was a good suggestion.
Yeah. I assume that video was in Italian.
Yeah, it was in Italian. Yeah.
Well, what is your? Do you have a YouTube channel then that people can check
I have
out?
a YouTube channel which I basically use to to convey educational content. There's an option course for beginners. There's a trading course for beginners. There's a a trading room where I publish the videos that I put on my site, but the day after the expiration of the trades, because those videos are reserved to to the subscribers of a newsletter. So
but if it was on your YouTube channel, I suppose somebody could use the translate function on the transcript, right?
yeah,
And they can...
I believe so.
Yeah. So yeah, maybe we'll make sure to get your YouTube channel link into the description as well.
Okay.
So for people who are interested, they can find their way back to that. FinWest pointed out that he sold some Palo Alto puts, and the benefit of the vol crush was that he actually could make even though the stock fell, the puts vol crush was sufficient that he could actually close for a modest profit even now.
Good.
I think part of the reason for that, so good for you, I guess one of the reasons is that it actually did, despite the fact that it fell, it has sort of gotten into this area. And we can kind of see, this is interesting, right? Because it got down into this range or level here, and then bounced, it got here, and then bounced, and then it got here. Will it bounce again? Good question. All of us have been, in a dining hall or at the restaurant, and the waiter drops a glass, and you hear it hit the floor, and it doesn't break right away. And you hear ding, Dink, dink. I have never heard it bounce a fourth time. It always shatters. I, that's what kind of a test is that for whether or not you decide that a stock might actually break at this point. Let's talk about from a fundamental perspective what I think about Palo Alto, and then we'll start talking about the charts. So things to like. We have very respectable growth. In fact, the anticipated top-line growth for Palo Alto Networks over the course of the next 12 months or so is probably about 20%. Now, remember, these fiscal years aren't quite in alignment, so really what you're looking at is some blend of this 15% and the 22.5%. But let's call it 20 to be reasonably charitable. They are looking, for whatever reason, at somewhat slower pace of earnings growth than, number one, it has enjoyed recently, and slower than the top line growth, which is going to be reflected in the fact that the company is going to have smaller margins. Generally speaking, as I often say, I want to see growth that's at least as good as the economy, at least as good as inflation, probably better, preferably at least as good as the S&P, and that is achieved by Palo Alto Networks, so that's good news. I like to see good free cash flow yield and good free cash flow yield growth. That also is pretty solid here. So we're looking at probably $4.5 billion in free cash flow over the next 12 months, which is a tremendous growth over the trailing 12 months. If you look at this, so we'll just round up to call that 3.6, so 4.5 over 3.6, free cash flow growth of 25% year on year. So then I can look at my free cash flow yield, which we'll call $4.5 billion versus, I'm going to round up and call it $117 billion. So 3.85%, but growing at 25%. Those are all pretty good numbers. So far so good, except for the margin compression. Don't usually like to see that, because when businesses are seeing margin expansion, just reflects outsized demand for their products. Take a look at NVIDIA. Maybe it's the best possible example of this. But to your point, Dom, technically this one's in a little bit of trouble for a couple different reasons. You had pointed out that it was trading close to its 52-week lows, which is by itself indicative that it hasn't been doing well lately. It's below every moving average. And most will probably know the old saw, nothing good happens below the long-term moving average. I'm sure you've heard that expression before. This is definitely one that I kind of like to keep my eye on the long side as something I like from a fundamental perspective, unless that margin compression is the sign of something more problematic. But what I really would like to see is for this thing to stabilize technically. Because right now it's kind of in that catch the falling knife phase. And when you sell cash covered puts, that's what you're doing. So I don't know that we have answered the question for our viewer. So my take on this would be, and you bought those before earnings. So actually let's take a look at this, because maybe we can come up with a little bit of a rule. So those are 170s. Those are July 170s. Let's do that. Let's take a look at these. I know some people who have kind of an automatic rule when they do debit spreads that if it loses 40% of its value, what they'll do is they'll just take it off. If they make a directional bet going into a catalyst and it loses 40% of their value, their attitude is very often, my first loss is my best loss. And they just say, I made a directional bet. I was wrong about that bet. I'm going to take it off. Because from my perspective, I almost would be more inclined to be a strangle seller in Palo Alto Network until I see it catch some form of a bid and begin to do a bearish to bullish reversal. But let's just take a look at what this call option has done since before the print to just after and see how much premium came out of it. So we had 1550 and now it's, well, 916. So you're basically right there 40%. 40%. So, if we were going to follow that as a rule of thumb, the recommendation here, Stephen, would be to take one's medicine. The probability that the 170 calls land in the money, which might be approximated if you ignored the technical aspects and how the stock's behaving, a simple proxy for the likelihood that this option is actually going to end up in the money would be just to take a look at its delta, which we can examine right now, and we will. So the delta of the July 170 calls is 40. So it's a 60% chance that this, a little bit more than a 60% chance that this loses money, because it's going to lose money at anything less than 179.16, which is the last for the calls, I think, right in that neighborhood. So it would actually need, for you to break even relative to that 916 price, it would need to get up to more than 179 just to scratch. And that's going to be closer to 180. So that's really more like 32% probability of profit. We kind of like to set up trades here that have higher probabilities than that. My suggestion instead would be take it off, move on, wait for it to reverse, stabilize, maybe break above the 50 or even the 20. If you're impatient, wait for it to break above the 20-day moving average. And if and as and when it does that, then maybe you can take a punter and say maybe it's going to catch a bid here. But absent that, I don't know that we have any real reason to think so. Also, sometimes when a stock sells off right after the print, if you really wanted to wait, say, 1 or 2 days, that's not going to make that much of a difference. A 3-day waiting period after negative news hits the stock is probably going to give you a better indication of whether the stock has identified and found a new level, because one of the things that reveals is whether real money accounts, like the big mutual funds that might have positions, they don't do a trade in one day. They'll start peeling out of it. And if they're going to, in response to something, the stock's going to actually feel heavy for several days persistently, and that would really be a clue that they're going to work. And that also is one of the reasons why when a stock does get hit and ultimately reverses, is that's essentially that working its way through the system. That's the way I like to think about it. Our positions are generally not that huge relative to what we call the real money accounts, the big mutual funds. If we had a position in Palo Alto Networks, it would probably be, 50, 60, no more than $70 million in one of the actively managed funds right now. Whereas if Wellington or Putnam or Fidelity or one of the big guys has a position, they could have huge positions. And in fact, why don't we see? We'll see what they've got. And let's see whether they were peeling out of some of it even beforehand. So, okay, so here's an important point. I tend not to look at Vanguard or BlackRock that much because those are mostly passive investors. So they have huge assets, but they tend to be passive. BlackRock has a lot of ETFs. Vanguard has some ETFs and some index funds. State Street is a custodian bank, similar sort of situation. But what I would look at would be, so Geode, and they've been adding, or at least they were as of the end of December. So these are some pretty chunky positions, right? So think about this. So this is a much bigger position than we would ever possibly have. These guys, 15 million shares of $150 stock. That's a lot of money. It's a lot of money. A couple $1 billion worth. So you kind of have to wait and see what these folks are going to be doing. But that's my take. I hope that helps. Dom, would you kind of go along with that? Generally?
What do you mean?
I mean, the idea that it's I don't really see this as a high probability trade, the July 170 calls. So I don't really think it's a great one to stick with.
Directional bets are completely against my way of doing the job. So I don't even know what to suggest in these situations, because
I think it's there are people who make a living and get good returns making directional bets in the short term. There are day traders, some are
Absolutely.
immensely successful. I tend, as people who watch this channel know, if I'm going to make a directional bet, I at least try to get the odds in my favor with things like call spread risk reversals, or situations where I'm collecting some premium. Give myself a little bit of a tailwind. Give myself a little bit of a cushion. Maybe bet that the thing's going to go up 10%, but not take risk if it goes down 10%, that kind of thing. So those kind of asymmetric payoffs that if you do a three-way trade, like a call spread risk reversal, you could do. But if you do those, then you want to go a little bit shorter dated than July, because a lot can still happen by July. And that vol crush would actually help you, but I don't know how much. But maybe FinWest can mention what expiration. So Matt McDonald says, why would Dom not sell equally delta'd strangles instead of limiting it to naked puts? Additional income with potentially equal opportunity outcomes. So I think Matthew McDonald is just asking a simple probability question, but I think I know the answer, but I'm going to let you answer it.
Short strangles on stocks going to release earnings. Well, actually, I think I wouldn't sleep at night being short called on a stock going to release earnings. And by the way, because you're betting on the crash in the volatility, of course, and that's the reason why you're taking into consideration the short strangle. The problem is, it all depends on the nature of the underlying, because if you're selling a strangle on McDonald's is a thing. If you're selling a strangle on I don't know, any mid or low capitalization stock, I have seen things that I couldn't believe if I didn't see them. Stocks multiplying 10 times in a single day. It often happens, of course, with pharmaceuticals and biotechnological companies, sometimes with technological, sometimes in disruptive sectors and the like. But you never know what could happen on the buy side. I have seen stocks that generally moved within a few percentage points make a plus 50% after one very good earning. So I wouldn't feel very comfortable in being naked on the call side. Sorry?
What was that, Jay? Our producer's just giving me a little more color. What was that? Okay. So, yes. So the follow-up. Oh, yeah, I see here. So he also said he does not take any event risk. So sells strangles between earnings. I'm in favor of this as a strategy in mega cap companies. So he's not a guest of ours today. We'll have to get him on. But my good friend and CNBC colleague Carter Worth does this. He specifically looks for stocks where a catalyst has come and gone. So he'll wait until there is an event, wait for a reset in the stock, and then sell strangles against it. Always in stocks that, one, don't have significant short interest, two, have no buyout risk, which limits things considerably, right? Because there are a lot of companies can get acquired, but some companies simply cannot. Alphabet cannot be acquired, not only because no one can afford to buy it, but because it would never be permissible. No regulatory body would permit it.
Absolutely.
So he does that in those circumstances. And actually, there's another good reason to do this. Very often, when a stock has a violent reset, that means some new and profound information has come to light. That's what causes the stock to gap in the first place. And number one, that information is going to be recent. So all investors are going to have about as fresh information and as much of an equal footing in terms of the information dynamic across the investors as they ever will have. If the news is bad, so if a stock gaps down, sometimes what would be the cause of that? It could be bad earnings. It could be accounting irregularities. It could be, a restatement or something like that. Those can cause profound downdrafts in a stock. But the good news is that management, when those things happen, especially if new management comes in, they try to do what we call kitchen sink it, which means they're just like, okay, look around, every bit of bad information, we're going to be releasing bad information anyway, and this is going to be where we're resetting from. So kitchen sink it, throw everything in the kitchen sink in terms of the bad information out now. So a short strangle position in that context can make a lot of sense. I will offer what I think is a challenge. I like the strategy. I will just offer the following, and that is that think about what we just came up with in BJ's. So what we said is you have a trade that has, via 10 different probabilistic models, you have a trade that has a high probability of success. And it is further supported by the fact that you're going to own the stock if it's put to you. So you know that the probability of being assigned is low, but you've accepted that risk as low as it is and said, I'm willing to be long the stock at that level. The problem with selling strangles more often than not is that a stock can be, if you're trying to value it, we never know exactly what it's worth, but it might be a little bit cheaper than we expect, and we might be willing to get put at some slightly lower level. The chances that we have so much precision in our assessment of a company's value that we can say, oh, I absolutely would buy it down 15%, and up 15%, it's way too rich, is a little arrogant, I would say, because it's suggesting we have such precision in our assessment of what the fair buying price and the fair selling price is, and that the stock is hovering between these two here and now. I'm not going to say it never happens, but it takes an alignment of all three things, right? You have to have implied volatility that looks like an attractive sale. You have to have a level at which you'd be willing to buy the stock. You have to have a level at which you'd be willing to sell the stock. And you have to be absent of potential catalysts that would cause outsized idiosyncratic moves that subject you to unnecessary risk. So does that ever happen? I'm sure it does, but I'm guessing that doesn't happen that often.
Yeah, I would also add a couple of things. The first is that in the end, there is not a good way to trade and a bad way to trade. In the end, it all comes to what suits your personal needs and inclination to risk and the like. And another thing is that it sometimes happens that the TradeAI platform suggests trades on stocks that are experiencing a very high volatility without earnings coming. In those situations, the probabilistic readings of the TradeAI platform are unreliable because the probabilistic algorithms of the platform TradeAI look back into the history of the prices in order to try and find, repetitive behaviors. If volatility is high for apparently no reason, it's something you cannot rely on in probabilistic terms because it's not something that repeats in time. It's something totally new, totally unpredictable. Indeed, I've been experiencing it several times. I've been using the TradeAI platform over the years since 2017. And in the beginning, I always focused on pharmaceutical company having implied volatilities up to 300%, 400%, okay? And what I didn't understand was exactly this, that if there are no earnings coming, why is the volatility so high? And what could happen that cannot be described by the probabilistic models? And I experienced a very tremendous loss. Theoretical loss, luckily, because I was able to recover it, but it took me almost 3 years on a pharmaceutical company that was experimenting a patch to prevent the anaphylactic shock of peanut butter. And they made a trial which completely, it was a complete disaster. And in a single, not in a single day, in 15 seconds, the price dropped from 22.50 to 160. And I was in with two naked puts 15. So I got assigned 200 shares for $15 each. And it took me 3 years to recover the loss selling calls against my position.
So you stayed in the stock?
Yeah, I stayed in the stock. I averaged the price, purchasing 1,000 shares for 180, so that my average price dropped to 390 and something. And every month and a half, I was able to sell calls, strike 250 for 0.10, 0.15. And it took me 2 years and 9 months to get away with it. And because, after 1 year collecting 15 cents a month, it's $1.80, which out of $4 is almost a 50%. So you're dropping the price of the stock month after month until you reach the parity and you get rid of the shares. And that's what I did.
Did you make this like one of your missions in life? Because it's very funny. I mean, an institute, it's really interesting because an institution would almost never do this.
Yeah, I
know. Because and there's a lot of reasons, and happily we haven't seen something quite like that. But one of the reasons you wouldn't do it is because if you get into a stock for a reason, and then all of a sudden you get crushing news. Our company does one thing. We solve the problem of anaphylaxis in people who are allergic to peanuts. So you have that as your underlying, and then they do a test, and it turns out, it doesn't do any of that. Well, we, as an institution, would say, okay, well, that's it. I mean, we're not going to own that stock. And not only that, it's on your sheets, which means that every single time your investors are looking, they're like, why do you still own this stock? Plus, a sub $5 stock, which is what that $22.50 stock fell to, would probably violate a lot of IPS, basically structures, which means because that's a penny stock, right? It's a sub $5 stock. So that's really interesting. But I kind of feel like you had a vendetta.
Yeah, I didn't want to give up. I wanted to prove myself that I could make it.
Well, 2 years and the fact that you know specifically what the price is, that's a funny thing. I think a lot of traders, this is true.
Yeah.
You remember certain trades really well.
Yes.
And more often than not, it's the bad ones.
Yeah. Yes.
The good ones, you book your profits, and if somebody says, what did you do? You remember generally, and maybe you even put some rose-colored glasses on it. But the bad trades, well, you can remember where you were when it happened, and every day since.
Do you remember
that was really helpful.
Do you remember the anecdote I told you last summer with regard to the currency futures? I was betting on the euro versus the Japanese yen. Do you remember that? It was,
for those who didn't hear it. Let's go through that. That might be a good thing to end on. Let's hear that story.
2003, so 22 years ago, and I was trading on currency futures back then, and I was testing, a systematic trading strategy which looked promising. So one night I got this signal on the euro versus Japanese yen exchange rate, which I had never traded before. And from my point of view, the currency futures market is open from midnight to 11:15 p.m. So by midnight, I placed the order with a stop loss and a take profit in my platform, and I went to bed. And the next morning when I got to the office, the real-time profit and loss in the book was minus 92,500. I started sweating because I thought it was euros, and it took me.
It was yen.
It was Japanese yen. I thought it was euros, and it was moving 2,500 every time. So 92,500, 95,000, and it was so early in the morning that nobody at the bank picked up the phone. So I tried to call my contact within the bank, and it took me 42 minutes to get a reply on the phone. And in the meantime, back then I used to smoke. I believe I smoked a packet of cigarettes. And when the guy finally picked up the phone and I asked him, please help me, I'm losing 100,000 euros. I don't know what to do. And after a few seconds, he told me, Domenico, wake up. It's Japanese yens. You have to divide by the exchange rate. And it was only 600 euros. And believe me, guys, in my life, I've never been so happy to lose 600 euros. You know,
Oh,
I
that is
remember
funny.
it as it was yesterday.
Mm. Yeah, I can imagine.
Mm.
Well, I think that's a good place for us to end it. We've used up almost an hour and 15 minutes of everybody's time. I hope everybody got a better sense of the statistical approach that the model is using and how something like that might be deployed. And if any of you, as I previously mentioned, I'll end with this, if any of you are interested in beta testing this platform and, taking a look at it for your own use, we are going to post a link in the description or an email address where you can send, the email to which you would like to get this. And for the viewers, we'll do that. So check back in 24 hours, and the reason is because we need to check with the platform developer to figure out what is the best approach. But for those who are interested, we'll make that available to you. And I'm going to start doing the same thing myself. Maybe we'll make this sort of a process. We'll go through all of these videos. And Dom, it was great to have you back. And I realize it's a late hour, but if you don't mind staying up late and drinking a little more coffee, I saw you drinking some
Yeah.
before we got started. Drinking coffee at 10, 11 o'clock at night. If you don't mind doing that, we'd
Absolutely.
love to have you back really soon.
Absolutely.
All right. Take care. Thank you all for watching. Like, subscribe, hit the notification bell. We'll be back next Monday, 4:15 Eastern Time. Dominic, as always, great to have you. Thank you so much.
Thank you.
And to all of you who are watching, thank you for doing so. We appreciate it.
Thank you all. Bye.